Okay, so you've settled on your investment property, you've used the Reventon formula and bought somewhere in the middle of the property pyramid. If you've used 20% deposit to fund the property, you've got 80% from a lender, this should mean you've got very good positive cash flow. What should you do with this residual income? You should be putting it into your owner-occupier. Pay down the owner-occupied debt as quickly as possible. Obviously, this isn't tax-deductible debt. We want to get rid of that as quickly as possible. The quicker we pay down that, the sooner we can go again. So you may have heard of negative gearing, you may have heard of positive gearing. What does this mean? Negative gearing means that your property is making a loss, which means that the cost to hold that property is less than the money that it's bringing in. Positive gearing means that the money that you're making through that property is paying for all of the expenses and some, which might give you that positive cash flow to either pay towards your owner-occupied debt, or if you only own that one property, pay down that debt much faster to build equity quicker. There's also another type of gearing which is called neutral, which basically means exactly that. It's basically not costing you anything to hold the property, it's covering exactly the repayments that you require. In today's market, there are a lot of properties that are actually giving you positive cash flow, but you're still negative gearing. How does that work? Basically what's happening is that your repayments are getting covered by the tenant. However, you've also got depreciation. So the extra depreciation and tax benefits that you're getting back at the end of the year comes through as positive cash flow, but you're not paying tax on that extra cash flow. So that comes as a credit at the end of the year when you're doing your financial credits. We can use that extra income to pay down your owner-occupied debt, or furthermore, pay down your existing investment property to build more equity. With interest rates the way that they are, it's pretty easy to get positive cash flow at the moment. If you use our Reventon formula and buy something between the 450 to 650 bracket, it's a very good chance that you'll get about a 4% rental yield. 4% should traditionally give you positive cash flow in this market. What do you do with extra cash flow? You put it towards your owner-occupied debt, or you wipe it off the principal. We'd all love to go on more holidays, but building equity is the best way to be building a portfolio. We'll make it happen so much faster. A lot of talk in the media right now about interest rates going up. Now, as an investor, you shouldn't be too stressed about that. The reason being, if you've got an owner-occupied loan and it goes up by 1%, and you've got an $800,000 to $1 million mortgage, that's going to put a hole in your pocket every month. However, on the investment property side of things, if the interest rates increase there, you're going to be claiming back whatever interest that is at the end of the year. It's not going to affect you anywhere near as much on the investment side as it would on your owner-occupier. This is why when interest rates do go up, we want to be constantly looking at the market to make sure that we've got the most effective loans in place. And the biggest one that we want to focus on is that owner-occupied debt. We use positive cash flow from the investment properties that we've got to pay down that as quickly as possible.